Are you ready for what's coming? Imagine waking up and discovering that everything you believed was safe. Your investments, your job, your financial peace of mind has started to crumble before your eyes. And the worst part? It was all announced in advance. You just didn't see it. While most people are celebrating record highs in the stock market, booming profits in tech companies, and an apparent economic boom, someone is doing the exact opposite, selling. And not just anyone. We're talking about Warren Buffett, one of the most successful investors in history. He's unloading billions in stocks, quietly, strategically, as if he knows something the rest of the world hasn't realized yet. What if I told you this pattern has happened before? Back in 2006, Buffett also started selling while the world was still celebrating. Shortly after, we saw the worst financial crisis since 1929. Now, in 2024, he's acting again with the same calm and precision. In this video, you'll understand why Buffett believes a new storm is forming and how he's preparing for it. More importantly, you'll learn how to protect yourself, how to spot warning signs, and how to turn a crisis into an opportunity. It doesn't matter if you have $100 or $100,000. What you're about to learn could mean the difference between losing everything or growing while others are panicking. If you're tired of being caught off guard, if you're finally ready to take control of your money and your financial life, this video is your turning point. Let's begin, before it's too late. Understanding the current economic context. To understand why Warren Buffett made such drastic decisions, we need to go back and carefully analyze the recent economic landscape. The year is 2024. Stock markets are booming. The S&P 500 is up nearly 10%. Companies like Tesla, Meta, Apple, and Nvidia are skyrocketing in market value. Wall Street is filled with optimism. For many, this seems like a new era of prosperity. The euphoria is spreading. TV pundits talk about the best time of the decade to invest. Influencers flaunt astronomical gains on social media. Beginner investors buy stocks without understanding the fundamentals. And the more experienced ones? Many are also blinded by the green charts. It's the classic pre-crisis scenario. Economic history is cyclical. Every time there's exaggerated growth without a solid foundation, the result is always the same: correction. The market returns to reality, and many fortunes vanish in the process. The problem is, when everything is going up, no one wants to believe that a crash is possible. That's the trap of false security. But Buffett doesn't follow the herd. While most were rushing to buy more stocks, he began pulling back. Quietly, without fanfare, he started selling positions in market giants. A counterintuitive move, especially during a time of apparent stability. The question many ask is, but why now? Just when everything seems so good? The answer lies between the lines. Buffett sees patterns most ignore. He doesn't invest based on emotion or headlines. He analyzes numbers, history, and most importantly, collective behavior. And everything he saw pointed to one destination: collapse. It's not the first time he's done this. In 2008, when the world still thought the housing bubble was just a minor issue, Buffett was already in a safe position, waiting for the right moment to act. Now, the same pattern is repeating. The difference? You have the chance to see it before the fall. And that's why, in the next chapter, we'll dive into the evidence behind this view and reveal how Buffett interprets the invisible signals of the market. The collapse of 2024. The beginning of the end. If you look at the numbers, everything seemed perfect at the end of 2024. Apple hit a $3 trillion market cap. Tesla soared over 230% in a single year. Meta rose 60%. Nvidia, 57%. For the average investor, that looked like stability, strength, and confidence. But for Buffett, it was a red flag. While the public celebrated easy profits, he saw something deeper: a growing disconnect between companies' market value and their actual ability to generate sustainable profits. Stock prices weren't reflecting fundamentals. They were reflecting euphoria. And that's where the danger lies. When everyone is buying, the market enters a kind of collective hypnosis. Few stop to ask whether the prices are justified. It's like a bubble that keeps inflating until it pops. And Buffett has seen this movie before. His moves were surgical. Instead of exiting in panic, like unprepared investors do, he started selling gradually, while prices were still at their peak. In Q4 of 2024, he sold about $17 billion in stocks. In the following quarter, another $75 billion, and in the last quarter of the year, another $35 billion. In total, over $120 billion in sales in just 12 months. A quiet and strategic retreat. But what did he see that others didn't? Buffett knew that the forces driving the market boom, low interest rates, excess liquidity, overheated consumer spending, were reaching their limits, and he saw the real economy already starting to crack. Persistent inflation, slowing consumption, rising default rates, and growing distrust in the banking system. On top of that, he recognized that many recent gains came from companies heavily dependent on expectations, not real results. Companies growing more from speculation than from actual cash flow. With that scenario, collapse wasn't a possibility, it was a matter of time. Buffett doesn't gamble. He plays with an edge. And that edge is time. By acting early, he avoids panic and prepares for what really matters, the opportunities that arise after the dust settles. While most people are still trying to figure out what's happening, he already has cash in hand, ready to buy solid assets at bargain prices. The decline started slowly. First, some stocks began to correct. Then came earnings revisions. Banks started showing signs of weakness. And suddenly, the narrative shifted. The market was no longer bullish, but uncertain. But for those following Buffett, this was no surprise. It was simply the logical outcome of a system built on unrealistic expectations. And as we'll see next, there was one signal in particular that, for Buffett, marked the ultimate turning point. His famous market indicator, a metric that had already predicted past crises and, in 2024, reached a historic level. Buffett's indicator and the market overvaluation. Among all the tools Warren Buffett uses to evaluate the market, one stands out for its simplicity and accuracy, the so-called Buffett indicator. It is the ratio between the total market capitalization and the country's gross domestic product, GDP. In other words, it compares how much companies are worth versus how much the economy actually produces. Buffett has publicly stated that if this indicator is below 100%, the market is cheap. If it's around 100%, it's fairly valued. But when it exceeds this level, especially above 120%, it's a warning sign. At the end of 2024, this indicator reached 210%. To understand how serious that is, consider that before the 2008 crisis, it stood at 107%. And before the dot-com bubble in 2000, it was around 140%. In other words, in 2024, the market was more overvalued than in any other modern crisis. That figure alone would justify caution. Yet most investors ignored it. Why? Because they were making money. And that often blinds even the most experienced. Buffett, however, is not easily fooled. He trusts the numbers, and the numbers showed a widespread bubble. A bubble inflated by years of artificially low interest rates, mass money printing, and unchecked optimism. The consequence? Stock prices grew far faster than company earnings. And when that happens, reality always catches up with fantasy. That's why, when the indicator hit 210%, Buffett didn't hesitate. He knew he was facing an unsustainable market, a rope stretched too tightly, ready to snap. At that moment, he accelerated his sell-offs, exiting key positions and strengthening his cash reserves. This move was not impulsive or speculative. It was based on decades of experience and a deep understanding of how market cycles work. And now, with the market on the verge of a severe correction, a new question arises, one that leads us into the next chapter. Which sectors are most exposed? And why does Buffett believe some of them will fall first? Buffett's strategic sell-offs. Buffett doesn't make random moves. Every sale, every portfolio adjustment is the result of meticulous analysis. And that's exactly what caught analysts' attention when, between 2022 and 2024, he began drastically reducing his positions in some of the world's biggest and most respected companies. What impressed the market most was the sequence and volume of these sales. In 2022, he was still relatively stable, but had begun shedding some less strategic holdings. The big moves, however, started at the end of 2022 and intensified through 2023 and 2024. In Q4 of 2024, Buffett sold around $17 billion in stocks. In the following quarter, $75 billion. In the last quarter of the year, another $35 billion in total. That's over $120 billion in sales in just 12 months. The most impacted stocks: Apple, Bank of America, General Motors, TSMC, Chevron, and US Bancorp. Let's start with Apple. Buffett had long avoided the tech sector. For years, he said he didn't understand these companies well enough to invest safely. But in 2016, he broke that pattern and bought Apple shares. His justification? Apple wasn't just a tech company. It was a consumer goods company with an extremely loyal user base, a closed ecosystem, and impressive margins. Over time, Apple became the largest position in his portfolio. But in 2024, that changed. Buffett began drastically reducing his exposure. Just in Q2 and Q3, he sold over 600 million Apple shares. Today, he holds a significantly smaller stake. Why? Buffett realized that Apple's valuation had outpaced its fundamentals. Even as an excellent company, it was being priced excessively. And, for him, that's a clear sign to sell. A similar situation occurred with Bank of America. Though it's one of the most integrated and solid banks in the U.S., Buffett understood that the macroeconomic environment was becoming dangerous for the financial sector. Rising interest rates, increased default risks, and waning consumer trust in the banking system were enough warning signs. He also reduced positions in other heavyweights like General Motors due to uncertainties in the automotive industry, and Chevron, though he still maintains significant exposure in the energy sector. The pattern is clear. Buffett is offloading overvalued assets and sectors with structural risks. He's not abandoning good companies. He's abandoning the wrong moment to be in them. While the market remains hypnotized by fast profits, Buffett is building up cash. And this leads us to an even more critical question. Which sectors does he consider most dangerous right now? That's what we'll explore in the next chapter. High alert sectors. Not every sector reacts the same way during a crisis. Some withstand the pressure, while others collapse. Warren Buffett understands this better than anyone. And when he began selling shares in specific segments in 2024, it became clear there were certain sectors he was deeply concerned about. The first is the technology sector. Over the past decade, tech companies have dominated the market. Record-breaking growth, rising profits, innovative products. But Buffett has always viewed this growth with caution. According to him, much of it was inflated by two artificial factors: massive money printing during the pandemic and historically low interest rates. The result? A bubble. Companies like Tesla, Apple, Meta, and Nvidia reached astronomical valuations, not because of proportional earnings, but because investors were driven by expectations, not fundamentals. Buffett believes many of these companies won't sustain those numbers. Those with fragile business models or that rely heavily on raising capital will be the first to fall. The second red flag sector is banking. Despite historically being a champion of big banks, Buffett began cutting key positions like Bank of America, US Bancorp, and Bank of New York Mellon. Why? Because the banking environment is becoming unstable. Rising interest rates squeeze bank margins, increase default risks among businesses and consumers, and threaten the overall confidence in the financial system. With the economy weakening and consumers growing more cautious, even the strongest banks may face withdrawals, profit declines, and credit tightening. The third concerning sector is real estate. During the pandemic, housing prices soared across many U.S. cities, fueled by low interest rates and government incentives. But after rate hikes began in 2022, demand dropped sharply. Buyers were scared off by expensive loans, while investors began doubting future appreciation. Buffett saw this as a bubble forming, and now that bubble is beginning to deflate. In many areas, prices have stalled or started to fall. This could trigger a domino effect, impacting construction, mortgage lending, and ultimately, the entire financial ecosystem. What do these three sectors have in common? They're highly sensitive to economic cycles, investor sentiment, and especially interest rates. These are sectors where leverage is common, and speculation, especially in tech, distorts prices and creates dangerous illusions. Buffett doesn't avoid risk. He simply chooses which risks are worth taking. And right now, he believes these sectors carry asymmetric risk. The potential losses far outweigh the chances of gain. The strategy is clear. Get out before the crash, preserve capital, and position where there's resilience, not fragility. And that brings us to the next chapter. Where is Buffett putting his money now? And which sectors does he believe will not only survive, but thrive amid the chaos? Buffett's new strategy: resilient sectors. While many investors chase fast profits in fragile sectors, Warren Buffett is looking in a different direction. He's positioning himself in companies that offer something rare during crises: resilience. But what does that mean in practice? It means investing in sectors that don't rely on market optimism or strong consumer spending. Sectors that keep operating and profiting, even when the economy is upside down. The first sector Buffett is reinforcing is energy. His main bet is Occidental Petroleum, a company in the oil and gas industry. Despite environmental pressures and promises of a green transition, Buffett knows the world still depends, and will continue to depend for many years, on fossil fuels. Gasoline, diesel, natural gas, and electricity remain basic necessities of any economy. Economic crises may reduce demand, but they don't eliminate it. That gives Occidental a relatively predictable revenue stream, even in turbulent times. Moreover, Buffett chose a company that controls much of its production chain, reducing operational risks and improving margins. For him, it's not just about investing in energy, it's about investing in the right company within the sector. Another focus is essential consumer goods. Buffett knows that during a crisis, people cut luxuries, but they don't stop buying food, hygiene products, medicine, and basic necessities. That's why he increased stakes in companies like Procter & Gamble, Kraft Heinz, and others that make products found in grocery carts every day. These companies offer three critical advantages. 1. Stable revenue. 2. Pricing power during inflation. 3. Strong consumer loyalty. Another interesting move was his investment in alcoholic beverages, particularly through Constellation Brands, which owns brands like Corona, Modelo, and various wineries. Though counterintuitive, this sector often shows resilience during tough times. Why? Because in periods of stress, uncertainty, and unemployment, many consumers maintain or even increase alcohol consumption. It's a historically recession-proof industry. And there's more. Buffett also invested in simple companies like Domino's Pizza. To some, an ordinary choice. But for him, it's strategic. In American culture, pizza is nearly essential. Cheap, convenient, and accessible. Even in tough times, families keep ordering pizza. That means stability, cash flow, and predictability. In short, Buffett is shifting his portfolio to sectors with three fundamental traits: consistent demand, reliable margins, a track record of surviving crises. He knows that true wealth isn't about following the crowd. It's about betting on what's solid. And while the world chases the next hype, Buffett is looking for safety with profitability. And to gain even more leverage during the crisis, he's preparing a silent but extremely powerful weapon: cash. That's what we'll cover in the next chapter. The importance of cash reserves. In the world of investing, many say that idle money is wasted money. But for Warren Buffett, at certain moments, idle money is a loaded weapon. While most investors rush to put every available cent to work, Buffett follows a strategy that at first glance seems conservative, even outdated, accumulating a massive cash reserve. By 2024, he had amassed over $324 billion in immediate liquidity. But why would someone like him keep so much money out of the market? Simple: because he understands the value of waiting. During a crisis, while most people panic, sell assets at rock-bottom prices, and desperately try to recover losses, Buffett watches, analyzes, and acts at the right moment. It's precisely in that instant, when everyone else is selling, that he is buying. And what enables that precise timing? Cash. With that reserve, he doesn't need to take unnecessary risks. He doesn't need to sell depreciating assets. And most importantly, he has total freedom to seize the best opportunities that appear when the market hits rock bottom. That's exactly what happened in 2008, when he bought shares of solid companies like Goldman Sachs and General Electric at unimaginable prices. And he's preparing to repeat the same move now. But this strategy isn't exclusive to large investors. It can, and should, be adopted by those who are just starting out. Having an emergency or opportunity fund brings peace of mind, allows for rational decisions, and prevents you from being forced to sell at the worst times. Even if you can only save small amounts each month, the habit of maintaining liquidity is one of the pillars of financial intelligence. Moreover, cash is a sign of discipline. It proves you're not investing out of impulse, but through strategy, that you know how to wait for the right moment. Buffett isn't waiting for the end of the world. He's waiting for the sale of the century. And when it comes, he'll be ready. The question is, will you be? In the next chapter, we'll understand what allows Buffett to stay calm when everyone else panics, and how patience became one of his greatest advantages in the investment game. The psychology of the investor: calm, patience, and false rallies. If there's one virtue that sets Warren Buffett apart from most investors, it's patience. In a world driven by urgency, anxiety for quick results, and emotional market swings, Buffett remains calm, even when everything around him seems to be collapsing. And that's no coincidence. He understands something most ignore. Markets are cyclical, and human emotions are predictable. That's why he doesn't overreact to sharp declines, and even less to apparent recoveries. This stance became even more evident in the face of the temporary rallies that occurred after the first signs of the 2024 collapse. Have you ever heard the term dead cat bounce? It's a market expression that describes a curious phenomenon. Even in a sharp downturn, there can be brief upward movements, which end up being false signals of recovery. They fool unprepared investors into thinking the worst is over, when in reality, the real drop is still ahead. Buffett understands these movements, and, more importantly, he knows not to act based on them. While many jump in at the first sign of a rebound, he watches. He knows that true crises unfold in phases. 1. The denial phase, where everyone believes it's just a temporary correction. 2. The false recovery phase, when small rallies restore euphoria. 3. The reality phase, when economic fundamentals prevail and prices collapse. Today, according to Buffett, we're between the second and third phases. Markets seem stable, and some assets have even bounced back. But it's temporary. The storm is not over yet. This is when the average investor is at the greatest risk, acting based on emotions, impulses, and false hopes. Buffett, on the other hand, operates with time and logic. He once said, "The stock market is a device for transferring money from the impatient to the patient." That quote sums up his philosophy. He doesn't need to guess the bottom. He just waits until great companies are cheap enough to justify the risk. That kind of patience is only possible when you have clarity of purpose and emotional control. Two invisible but extremely valuable assets. And with these assets, Buffett turns crises into profits, spotting opportunities that others don't see, or see too late. In the next chapter, we'll talk exactly about that. How to find those opportunities even amid chaos, and which sectors are most likely to thrive while others panic. Crises create wealth for those who are ready. There is a silent truth in the financial markets. The greatest fortunes aren't made during good times, but in periods of crisis. And few investors have demonstrated this better than Warren Buffett. While most see collapse as a tragedy, Buffett sees it as a rare window of opportunity, a chance to buy valuable assets at a fraction of their price, to invest when everyone else is fleeing, and to build wealth when fear paralyzes the world. But be careful. This strategy isn't about being opportunistic. It's about being prepared. And what does it mean to be prepared? It means having already done your homework, studied the market, selected good companies, built a cash reserve, and, above all, developed the right mindset to act while others are frozen by panic. During the 2008 crisis, for example, Buffett went against the market. While many were selling in despair, he was buying shares of companies like Goldman Sachs and General Electric, and reaped extraordinary profits when the market recovered. And now, in 2024, he's doing the same, selling at the top, building up cash, and waiting for the ideal moment to buy back in. But not just any company survives chaos. Buffett looks for businesses with anti-fragile characteristics, solid business models, predictable cash flow, essential products or services, strong leadership and established brands. Sectors like energy, basic consumer goods, and alcoholic beverages are classic examples. They continue to generate revenue even during recessions because people still need to eat, take care of themselves, and, in many cases, relieve stress. Another strategic bet is investing in companies that, despite being temporarily shaken, maintain clear competitive advantages, ensuring they'll bounce back even stronger after the crisis. Buffett doesn't try to guess the market bottom. He simply positions himself so that when it hits, he has liquidity, clarity, and the courage to act. And that's the key. A crisis doesn't destroy those who are prepared. On the contrary, it rewards those who had the patience to wait and the wisdom to understand the cycle. And it's precisely this cycle that leads us into the next chapter. Because if what we're living through now looks familiar, then maybe the answer lies in the past. Let's go back to 2008 and understand how that crisis teaches us everything we need to know about what's happening today. The mirror effect, 2008. Crisis versus today's crisis. For those who closely follow economic cycles, 2024 feels like a replay, almost a mirror, of the years leading up to the 2008 crisis. And it's precisely this similarity that has Warren Buffett concerned. Back then, the signs were there. The housing market was overheated, credit was flowing freely, and financial institutions were taking disproportionate risks. The economy seemed stable until it wasn't. And when the bubble burst, it took down banks, corporations, and global confidence. Now, in 2024, many of those elements are reappearing, just in new disguises. Instead of the housing sector, it's the tech sector at the heart of overvaluation. Companies with modest or even non-existent earnings have reached billion-dollar valuations. The logic? Irrational optimism. Just like before 2008, the market believes growth will never stop. And that belief is the fuel behind bubbles. In the previous crisis, it was private debt that lit the fuse. Now, it's U.S. public debt that sets off alarms. With rising government spending, higher interest rates, and growing deficits, the government is under more fiscal pressure than ever, and its ability to respond to a new crisis is much weaker than it was in 2008. Another parallel is Buffett's behavior. Before the 2008 crash, he quietly began reducing his positions in banks and insurers. Long before headlines hinted at a crisis, he saw the cracks before they became ruptures. And while the world was still dancing to the music, Buffett was already leaving the party. Today, he's repeating that pattern, selling shares in giant companies, bolstering his cash position, and steering clear of vulnerable sectors. To many, it seems like an overreaction, but to those who know his history, this pattern is a clear signal. He's seen this movie before, and he knows how it ends. Of course, no two crises are identical, but there are psychological, financial, and structural patterns that repeat with surprising frequency. And Buffett built his fortune by recognizing these patterns and acting before it's too late. The lesson here is clear. Those who ignore history are bound to repeat its mistakes. Those who learn from it, like Buffett, get ahead. And that foresight is built on one central philosophy, which we'll explore next: investing only in companies with true protection against competition and time. It's time to talk about economic moats, the concept that guides all of Buffett's decisions and that can completely change how you invest. The power of economic moats. For Warren Buffett, the true strength of a company isn't found only in its current profits, but in its ability to sustain those profits over the long term, even in the face of competition, economic changes, and crises. This concept is what he calls an economic moat. But what exactly is an economic moat? Imagine a castle surrounded by a deep, impassable moat. That moat protects the castle from invaders. In the business world, the castle is the company, and the moat is everything that protects it from direct competition. Buffett looks for companies with wide and deep moats, businesses that are hard to copy, hard to replace, and hard to defeat. These moats can take many forms. 1. Strong brand. Companies like Coca-Cola don't just sell soda. They sell experience, tradition, and an emotional connection with the consumer. This allows them to charge premium prices and maintain customer loyalty even amid intense competition. 2. Exclusive distribution network. Coca-Cola itself is a great example. Present in over 200 countries, in restaurants, supermarkets, gas stations. Competing with that kind of reach is nearly impossible. 3. Lower operating costs due to scale. Companies like Chevron operate on a large scale with operational excellence, enabling them to reduce costs and maintain high margins even when oil prices fluctuate. 4. Closed ecosystem. Apple is the perfect case. Its products and services are so tightly integrated that, once inside the ecosystem, it's hard to leave. This ensures extreme consumer loyalty and recurring revenue. 5. Unique business model. American Express doesn't just compete by offering credit, but by delivering a sense of status and exclusivity. Their customers pay for a sense of belonging, a competitive advantage other credit card companies can't replicate. For Buffett, these moats are far more valuable than trends or fleeting innovations. They are long-term barriers that ensure the company can grow, defend itself, and thrive for decades. And this philosophy is the opposite of the short-term mindset that dominates the market. While many investors chase the next big stock, Buffett looks for companies that will still be relevant 20, 30, or 50 years from now. He'd rather buy an excellent company at a fair price than a mediocre company at a bargain. Additionally, economic moats protect investors during crises. A company with a strong customer base, market presence, and real competitive advantages can weather difficult times without compromising its future. That's why Buffett tolerates market price fluctuations, but not weaknesses in fundamentals. And that's why, in times of crisis, he prefers to invest in businesses with deep moats rather than in volatile promises of quick returns. In the next chapter, we'll see how this philosophy translates in practice into 5 of Buffett's biggest bets. Different companies, different industries, but all with one thing in common: an almost unbeatable economic moat. Buffett's 5 biggest bets. Warren Buffett doesn't invest in dozens of companies out of fashion or forced diversification. His portfolio is selective, and his top holdings clearly reveal what he values most: resilience, predictability, competitive advantage, and deep economic moats. Let's break down 5 of his biggest bets and what they all have in common. 1. Apple, the unbreakable ecosystem. Despite his traditional caution with tech companies, Buffett made Apple the largest position in his portfolio. Why? Because Apple is not just a tech company, it's a closed ecosystem. Its products and services are deeply integrated and addictive. iPhone, Apple Watch, AirPods, Mac, iCloud, Apple Music. Everything connects seamlessly. And once you're in, it's hard to leave. This generates recurring revenue, customer loyalty, and massive profit margins. Apple also has consistent cash flow, a global brand, and a user base that behaves more like fans than customers, a moat that few can replicate. 2. Coca-Cola, a brand that defies time. Buffett has invested in Coca-Cola since the 1980s, and he's never sold a share. That says a lot. Coca-Cola doesn't just sell soft drinks. It sells emotion, memories, and routine. It's a global brand present in over 200 countries, with unmatched logistics and strong pricing power. Even in times of crisis, Coca-Cola doesn't stop selling. In some places, it's easier to find than clean water. This branding and distribution power creates a nearly impenetrable economic moat, something that protects the investment even in tough economic environments. 3. Bank of America, a complete financial system. Among all the banks, why did Buffett choose Bank of America as his top bet in the financial sector? Because it's not just a bank. It's a complete financial ecosystem, offering integrated services, checking accounts, credit, mortgages, investments, and wealth management, all in one platform. This creates convenience and loyalty. A customer using multiple services is likely to stay for years or even decades, and that retention is a powerful moat. 4. American Express, status as a product. While Visa and MasterCard compete on volume, American Express competes on perceived value. Its clients pay high annual fees in exchange for exclusive benefits, premium services, and experiences that communicate status and prestige. It's an aspirational brand, and that creates a virtuous cycle. The more premium the brand, the more high-net-worth clients it attracts. The more such clients it has, the more luxury brands want to associate with it. It's a difficult model to replicate, which is why Buffett hasn't sold a single share of the company in over 12 years. 5. Chevron, efficiency across the energy chain. In the energy sector, Buffett prefers companies that control the chain from start to finish. And Chevron does exactly that. It operates from extraction to refining and distribution. This reduces risks, improves margins, and ensures stability in a volatile sector. Additionally, its scale and operational efficiency make it less vulnerable to oil price swings. Buffett knows that, even with energy transition in the spotlight, the world still depends, and will for a long time, on oil and gas. These 5 companies operate in different industries, but they all share a common structure: wide economic moats, predictable revenue, and strong branding. In the next chapter, we'll explore how Buffett analyzes these elements before deciding where to allocate billions of dollars, and how you can apply the same reasoning even with much less capital. How Buffett chooses companies. For Warren Buffett, investing isn't a guessing game. He doesn't bet on passing trends or chase quick profits based on rumors. His method is simple, yet disciplined. He invests only in companies he deeply understands, and that possess durable competitive advantages. But what does that mean in practice? Buffett asks himself three fundamental questions before investing in any business. 1. How does this company make money? The first analysis is about the business model. It must be simple, predictable, and transparent. If he can't explain in one sentence how the company generates profit, he simply doesn't invest. Buffett avoids complex businesses with too many external variables or those reliant on fads. He prefers companies that offer products or services people will keep buying 10, 20, or 30 years from now. 2. What protects this company from the competition? This is where the concept of an economic moat comes in. Buffett wants to know what prevents other companies from copying the business and taking over the market. It could be an extremely strong brand, like Coca-Cola, a loyal customer base, like Apple, a closed ecosystem, like Bank of America, or an exclusivity-based model, like American Express. He looks for real barriers, not just temporary advantages. 3. Is this company built to last? Buffett invests with the intent to hold the stock for decades. That's why he analyzes the company's culture, governance, management history, and ability to adapt. He seeks businesses that reinvest in innovation, grow sustainably, and withstand crises without compromising the quality of their products or services. This long-term mindset is what sets him apart. While many investors look at the next quarter, Buffett looks at the next 30 years. And the best part, any investor, even with little capital, can apply the same logic. Just ask the right questions, study the fundamentals, and resist the urge to invest impulsively. In the next chapter, we'll hear from other voices, renowned economists who, like Buffett, are predicting something big. And it's not rapid growth, but rather an imminent global crisis. Economists' views on the future. Warren Buffett isn't alone in his warning. Several world-renowned economists are also pointing to what they see as a perfect storm forming in the global economy. And although their analyses come from different perspectives, their conclusion is almost unanimous. The global financial system is dangerously unbalanced. One of the first to raise a red flag was Nouriel Roubini, professor at New York University, and famous for accurately predicting the 2008 crisis. In recent interviews, he states that the world is on the brink of another crisis, not due to a single factor, but to a combination of many. Excessive debt, geopolitical tensions, asset bubbles, and systemic risks built up over the years. Roubini believes that many countries are so heavily indebted that their governments will have very limited ability to respond to the next crisis. This magnifies the impact of any downturn, making it deeper and longer lasting. Another key voice is Robert Shiller, Nobel Prize-winning economist. In his analyses, he highlights the irrational exuberance present in the stock and real estate markets. Shiller points out that today's prices are far above their fundamentals, a classic sign of a speculative bubble. And as we've seen in past crises, every bubble bursts. The only question is when. Kenneth Rogoff, professor at Harvard University, also warns of a potential global crisis driven by both public and private debt. According to him, central banks have become too reliant on expansionary policies, low interest rates, and liquidity injections, which have created an artificially stable environment. But this stability is fragile. And when interest rates rise, as they have since 2022, the cracks begin to appear. Ray Dalio, founder of Bridgewater Associates, reinforces the idea that we are at the end of a major global debt cycle. He sees today's conditions as similar to those that preceded major historical crises, including the Great Depression of 1929. Dalio also warns of the growing risk of social and political instability, which could further amplify any financial collapse. Lastly, Jeremy Grantham, a market veteran and co-founder of GMO, doesn't mince words. He says we are facing the biggest bubble of all time, both in the stock market and in real estate. These voices, different in style but aligned in conclusion, make it clear that this is not a conspiracy theory, but a grounded interpretation of global data. Buffett, as always, doesn't make alarmist public predictions, but his actions speak volumes. And when so many respected experts begin pointing in the same direction as him, the question is no longer if the crisis will come, but will you be ready when it does? In the next chapter, we'll explore how Buffett is preparing for a potential prolonged crisis and why he believes the worst may still be ahead. The future, according to Buffett, 2025-2026. Warren Buffett is not known for making apocalyptic predictions, nor does he act out of panic. But when he starts moving billions of dollars out of stocks and into cash, the world pays attention. Because historically, these moves precede critical moments, as they did in 2006, before the 2008 crisis. Now, based on his most recent decisions, it's clear that Buffett does not believe the 2024 crisis is just a short-term fluctuation. In his view, we're facing a deeper and more prolonged crisis, with effects likely to extend into 2025 and possibly 2026. But why does he think this? Buffett bases his outlook on three pillars. 1. Out-of-control inflation. Despite interest rate hikes that began in 2022, inflation remains persistent. Essential goods like food, energy, and basic services continue to rise in price. And when the cost of living grows faster than wages, people's purchasing power declines, directly impacting consumption, confidence, and economic growth. Buffett sees inflation as the greatest enemy of the investor because it silently erodes the value of both money and assets. In his view, the current environment makes it extremely difficult to protect and grow capital without a clear strategy. 2. The explosion of public debt. The United States, like many developed nations, has accumulated record levels of debt. After the pandemic, stimulus packages were massive. But now, with higher interest rates, the cost of rolling over that debt has become unsustainable. The result? The government must allocate an increasingly large portion of its budget to paying interest instead of investing in healthcare, infrastructure, or economic growth. According to Buffett, this makes the economy more fragile and less resilient to shocks. 3. The bursting of the tech bubble. Buffett has warned repeatedly. Many tech companies are absurdly overvalued, sustained by hype and optimism rather than consistent results. And while some of them have already dropped, he believes most are still overinflated. When these companies are finally repriced according to their real fundamentals, the impact could be devastating, not just for investors, but for the market as a whole, given how heavily these giants weigh on global indices. These three factors, persistent inflation, unsustainable debt, and sector-specific bubbles, together form what Buffett sees as a slow, dangerous cycle of deterioration. It won't be a sudden collapse, but rather a series of drops, false rebounds, and gradual devaluation that will demand patience and strategy from those who wish to survive. And that's why he's already preparing, not just to protect himself, but to take advantage. In the next chapter, we'll understand how he turns preparation into opportunity, with a practical strategy that anyone can start applying today. The Buffett Guide to Financial Survival. Warren Buffett doesn't just protect himself during crises, he grows in them. While most investors panic and sell their assets for pennies on the dollar, he positions himself to buy the best companies at fire sale prices. And he does it based on a set of simple but powerful principles. Principles that anyone can apply, regardless of how much money they have invested. Here's the essential guide, inspired by Buffett's strategies to survive and thrive in times of crisis. 1. Build your cash reserve. This is the foundation of everything. Buffett always keeps a huge amount of liquidity on hand. Instead of putting every dollar into stocks, he sets aside a significant portion in cash, waiting for the right opportunity. You can do the same. You don't need billions. Just set aside a portion of your income each month. When the market drops, and it will, you'll have the funds to buy valuable assets while everyone else is selling. 2. Reduce exposure to overvalued companies. Buffett doesn't invest in trendy companies. He avoids those that rise too fast without solid fundamentals. That's why one crucial step is reviewing your portfolio. Ask yourself, does this company actually generate profit? Does it have a sustainable business model? Or is it inflated by hype and speculation? If the answer is unclear, consider reducing or exiting the position. Preserving capital is the priority. 3. Invest in defensive sectors. Buffett focuses his bets on sectors that continue operating even during recession. Energy, like Occidental Petroleum, basic consumer goods, food, hygiene, medicine, alcoholic beverages, like Constellation Brands. These sectors don't rely on luxury, trends, or optimism. They offer predictability and safety, even in the worst moments. 4. Stay calm and be patient. Perhaps the hardest and most important advice. Buffett constantly reminds us that the market is a game of patience. Time is the friend of the wonderful business, the enemy of the mediocre. Don't panic during downturns. Don't try to guess the bottom. Invest slowly and calmly when prices make sense, and trust the long term. 5. Focus on companies with stable cash flow. Buffett chooses companies that keep generating money in any scenario. This ensures they can pay dividends, invest in growth, and weather storms. Forget about companies that survive only by constantly raising capital. Bet on those that can sustain themselves. These 5 pillars form the foundation of Buffett's crisis time strategy. And by applying them, you don't just protect your wealth, you position yourself to grow, while most are pulling back. In the next chapter, we'll go beyond protection. We'll talk about how to think like Buffett over the long term, and how to turn your vision of financial freedom into a real plan. One built on knowledge, autonomy, and purpose. Financial education and freedom. Buffett's philosophy. For Warren Buffett, true financial freedom doesn't begin with money. It begins with knowledge. Before investing his first dollar, Buffett spent years reading, studying, and understanding how money works. He always says, the best investment you can make is in yourself. This isn't just a catchy phrase, it's a life principle. Buffett believes financial education is what separates the lucky from the consistent. It's what transforms an ordinary salary into real wealth. Knowledge lets you see opportunities others ignore, and more importantly, helps you avoid mistakes that can be costly. But it's not just about reading books or watching videos. It's about developing a new mindset, thinking long-term, avoiding shortcuts, learning from market cycles, questioning easy promises, analyzing businesses with calm and logic. Buffett also teaches us that true wealth isn't just financial. It's the ability to make decisions without fear. It's having control over your time. It's living without relying on your next paycheck to survive. Financial freedom doesn't mean having millions in the bank. It means being able to say no to what doesn't make sense. It means having choices, and those choices begin with small habits. Learning before investing, saving before spending, asking why before saying yes. Buffett's philosophy is simple yet powerful. Build the foundation before chasing results. He didn't become wealthy by taking reckless risks. He got there by respecting time, using logic, and acting with discipline. Today, you have access to the same kind of information Buffett studied early in his career. What will set you apart isn't what you know. It's what you do with what you know. In the final chapter, we'll close this cycle with a powerful reflection. Crisis is inevitable, But personal collapse is optional. What you do from this moment forward will determine who you become when the storm passes. We've reached the defining moment of this journey. You now know what Warren Buffett is doing, and more importantly, why he's doing it. While many choose to ignore the signs, he anticipates them. While some rely on luck, he prepares with strategy. And now, you have the chance to do the same. Crises are inevitable. They always have been. But what separates those who break from those who grow is preparation. You can wait for the collapse to happen, or you can position yourself ahead of it with intelligence and prudence. The decision to protect your money, seek knowledge, and build a plan, none of that depends on luck or the size of your bank account. It depends on your mindset, and that mindset is built through small, daily decisions. Choosing to learn before following the crowd, questioning promises of easy profits, saving when everyone else is spending, investing with logic when others act out of fear. Buffett didn't get where he is by being smarter than everyone else. He simply respected the fundamentals. He understood that in the financial game, patience beats haste, and that the real risk lies in not knowing what you're doing. So now the question is, will you wait for the crisis to hit you, or will you prepare to take advantage of it? You have the knowledge. You've understood the signals. You've seen the examples. The choice is yours. The journey to financial freedom doesn't start with a big move. It starts with a small decision made today. And as Buffett always reminds us, someone's sitting in the shade today because someone planted a tree a long time ago. So plant your tree now. Protect your capital, educate yourself, invest with purpose, and when the market shakes, because it will, you'll stand firm and ready. The journey to building a strong financial mindset doesn't end here. It begins here. You've just walked through the same mental paths that Warren Buffett takes every time he makes an investment decision. You've seen how he thinks, where he invests, what he avoids, and most importantly, how he acts when the world is panicking. But now, the most important question isn't about Buffett. It's about you. Will you ignore the signs and keep reacting to events? Or will you finally take control and become the architect of your own financial future? Buffett doesn't have superpowers. He wasn't born rich. He didn't have access to secret formulas. What he had, and cultivated, was the ability to think independently, to keep learning, and to act with consistency over time. And you can too. The difference between people who achieve financial freedom and those trapped in fear, debt, and instability lies in something very simple: action. Action to start saving. Action to study before investing. Action to build your emergency fund. Action to invest in what truly matters. Action to stop following fads and focus on what's sustainable. The coming crisis can be the worst moment of your life, or the greatest opportunity you've ever had. It all depends on how you choose to face it. So here's the final invitation. Take control. Don't wait to hit rock bottom to start. Start now, with what you have, with what you know, and with what you've learned here. And if this video inspired you in any way, don't keep it to yourself. Like the video, subscribe to the channel, leave a comment below. Today, I choose to protect my money. Share this content with someone you care about. Because the next crisis won't send a warning when it arrives, but those who are prepared will go through it growing. You're ready. Now it's your turn to act. See you in the next video.